Good morning, and first of all, thank you very much to the Socionomic Institute for inviting me across and providing the opportunity to give my thoughts on the subject matter. And I thought the way that we'd play, well, first of all, a little bit of backdrop on who I am. My name's Charlie Aitken. I'm 30 plus years investment practitioner where I've managed, advised, analysed, written, spoken, listened about the investment markets, and for most of that time, it's fair to say I've been I'm blessed to be a born contrarian, and if I've got to be pigeonholed, it would be as a value investor. And for certainly the early part of my career, I would base most decisions on what's known as fundamental analysis as opposed to technical analysis. Migrated more to the technical backdrop in the late 1990s, and then really more luck than judgment, I tripped across Bob Prechter and the Elliott Wave team, and subsequently the burgeoning team on the Socionomics side, which was manna from heaven for Contrarian, and there was just a natural affinity between the two. Hence I thought I'd title today's presentation Contrarians are born as opposed to Socionomics have to be taught. So without further ado, there's the agenda. I'll have a look through the highlights of the Contrarian facts over the career. A precede view of it, you'll be pleased to know. The natural affinity, as already mentioned, with Socionomics. How Socionomics has kept my sanity in what's turned out to be a very protracted wave B. Expand a little more about real versus nominal, which really Bob and the team brought to my attention, and many others in 2006, if I remember. A sort of mystery subject there that's in red, which we'll come on to, and then I'll wrap up. So without further ado, let's look at the autumn or your fall of 1989, and I'd been invited along to a presentation by a Japanese fund manager who was a Brit but happened to be the top performing Japanese equity mutual fund in the UK at that moment in time, to hear his views. And you may or may not be surprised to know that he was very upbeat, very positive about the market, and as the Nikkei index was fast approaching 39,000, he was talking about a target of 100,000 and maybe higher, which together with a slide that came to my attention from elsewhere, which was the Nikkei Dow index against the cost of golf course membership in Japan at the time, where it was so high that it was cheaper for Japanese golfers to fly down to the Gold Coast in Australia and play rather than join a local club, than to a contrarian that was setting alarm bells ringing to say this is unsustainable, you know, even at late 30,000s. And as I've put there, a simple sort of rate of change on the lower part, the blue line, says that at the time the stock market was annualising at 29% per annum, and that's just not normal. So that was sufficient enough for me to offload what we had exposed to Japan at that moment in time. So we may not have got the last couple of percent, but it wasn't a bad call. We'll stay in the East and move on now from 1989, where, by the way, for those who need reminding, the Nikkei fell all the way back to best part of 7,000 from nearly 40,000. Land prices fell by 80% over the subsequent years, and there they are still now, best part of 25 years later, with the stock market still at less than 50% of what it was back then. So there's lessons there just to say about, from a boom and bust that's been credit driven, just how long it takes to unwind. Because of the Institute's great analogy about popular music and movies, I've tried to look back at what the top 10 hits were in any particular year. And for 1989, it was The Only Way Is Up by Yaz, which was obviously quite fitting. And lest I forget it, as far as Hong Kong's concerned, it was I Believe I Can Fly by R. Kelly, which again is quite a good fit for that. Anyway, we'll now move on to 1997, and I was fortunate enough to be invited along to 4 what were called Tiger Tours. They were really tours of Asian economies in conjunction with a mutual fund group in the UK called Aberdeen Fund Managers, who now are actually the largest fund management group in the UK. And it was through their Singapore office where it would vary. I was lucky to go along about 4 of these, and there'd be anything from 10 to 12 of us as practitioners, and we'd hook up with one of their fund managers out of the Singapore office, visit 6 different countries around Asia, which they had company visits to complete for due diligence, which were companies that they were invested into in these different economies, and it gave us the opportunity to have a listen and get a feel for their local economies and kick the tyres and the rest of it. So anyway, on one of the tours, which was 1997, there were 2 whole days that were spent in Hong Kong, which was an interesting time in itself, because that's when Great Britain handed Hong Kong across to China, and but also, whereas the Asian crisis had started in June of that year in Thailand, it dominoed through Asia, and the last man standing effectively was Hong Kong. And we were hosted during the one full day that was there by a property company called Sino-Land, which is still listed on the Hang Seng Index. And we did 2 visits. We went across to what was the now the new international airport. And frankly, they were 3 tower blocks that were really, you'd call budgie boxes. They were 400, 500, 600 square feet, so very small apartments. But the 600 square foot apartments, bearing in mind this is 1997, were retailing at $250,000 US dollars at the time, which begged the question to the Sino-Land representative, out of interest, what are average wages in Hong Kong for Hong Kong Chinese, not the expatriate community, because obviously that distorts. And the lady's answer was about 18,500 sterling, which would equated just about at the same time for average salaries in the UK, which would have been somewhere around about 25,000 US off the top of my head, which then begged the second question to say, well, how do people on 18,000 sterling a year affording $250,000 apartments? To which the answer was they use their pension fund, the Provident Fund. And she didn't feel that that was slightly dangerous or anything. It was just the norm of what was done. But it was interesting to look at those, and then we swung across onto the onto Hong Kong Island, and the higher you go towards the peak, obviously to live on the top is the most expensive area. That's the luxury part, and it becomes progressively more expensive as you head up to the peak. So we went sort of mid-level, and here the second example was a block that had been demolished and then rebuilt. And if I recall off the top of my head, there were about 17 apartments, totally different than the first. They were 2,500 square feet apartments with a bit of servant quarters tagged on the end. And the developer was in no mood and no intention whatsoever to sell these, because the prices were going to continue to go up and up. And they were all for rental, and the rental then was 180,000 sterling per year, so about 15,000 sterling per month. Again, reminding this is 20 years ago now, in 1997. Well, when we came out of that visit and we were waiting for the transport to take us back to the hotel, a sort of back of a cigarette packet calculation suggested there that if he was 100% occupied, the yield on this investment was sub 4%, probably about 3.7%. Money on the street would earn you 6.5% at the time. And again, it seemed a non-brainer, something wasn't right. Bearing in mind that 30% of the Hong Kong stock index was property related stocks, that was sufficient for me to phone back to the office in the UK, where at that time we had 2, maybe 3% Hong Kong exposure, and said to my colleagues, sell, offload it. And the index topped on a daily basis, not far short of about 18,000, and within months it was knocking on the door of 7,000. And the chart that you can see there is to show the close relationship between average residential home prices in red against the Hang Seng index, and as you can see, they go hand in glove. Okay, so we'll move on in time by 2 years for the towards the end of what turned out to be the TMT bubble in 1999, and as already mentioned, I'm very much a value investor, driven at the time very much by fundamentals. So it was starting to cry out amber warning sign to say this is getting to ridiculous levels, and it just didn't feel right. Something had to continue. So whether it was in the UK or looking at the US, so we saw things like some of the internet stocks on price earners of far north of 500 times, stock market to GDP at 150% versus the bubble top in Japan at 135%. The same warning signs were there for us all to see. And so, not surprisingly, I was starting to feel a tad bearish about Western markets, and started to look about for instruments that I could use to be able to profit from what I expected to be falling markets. In the event, and I do recall one of Elliott Wave's papers coming out at one time and reminding about the number of mutual funds that were available at the beginning of Bob's professional entrance in about 1975-76 to how many were there in the late 1990s, and indeed how many there are now. Well, in the UK's case, I can tell you it was 400 unit trusts in when I tripped into the industry in the early 1980s, to 2,000 in late 1999. And of those, 98, or should I say 1,998 were long-only funds, and there were literally two bear funds, which were reverse index trackers available from a group called John Gavett. And as shown on the slide there, they actually launched them in 1991 when they were about as much use, and you can understand why that happened, because that was the aftermath of the 87 crash. So there was a demand for people looking at in difficult markets for something other than a long fund. But just in time for a 200% rise in the FTSE index, and but anyway, they were ideal for me. So anyway, by late 1999, we actually owned between 35 and 40% of the two funds that they had to offer, and just unbelievably, months before the end of 1999, because the demand wasn't there, they, in their wisdom, they decided to close. And so as we can see, that was their timing to launch the funds. That was their timing to close the funds first time round, because between myself and chap who operated a practitioner out of Bristol held 50% between us, we managed to get a stay of execution only for a month or 2 months, when we could get a, well, it was a fax back then as opposed to email, to about 50 discretionary players throughout the UK to effectively say, well, look, you either use it or lose it as far as these instruments are concerned. We had a response rate of about 20%, which wasn't bad, but to a man or woman, they all said, well, we don't want to lose it, but we don't feel that we could use it at this moment in time. which of course now with a socionomic hat on and looking back, they would say that, because everybody was extrapolating the TMT bubble forward forever and a day, till trees got to the sky. So they closed them. Then in late 2002, early 2003, Gavettes were acquired by a fund management company called Gartmore, and in their wisdom, they felt that there was a requirement for the two bear funds, so they relaunched them. Again, of course they would, because this is down here, and everybody's extrapolating forward the fall going to continue. And unbelievable time, and they then decided again, because there was no demand after a 5-year bull market, that in July 2007 they closed the funds, and they've never reappeared since. And in that late 1990s, by the way, in the top 10, Believe by Cher. It was also perhaps more fitting by Madonna, was The Power of Goodbye. But that was effectively my history at the time, from when I'd set up a discretionary service from back in 1983. And so I was well due a pretty well defined wave 1, sideways wave 2, wave 3 up to here, and I was in a wave 4. Not that I realised it at the time, because I'd never heard of Elliott waves, but I was certainly overdue a wave 4. And at that moment in time, what had caused the downswing was I was too early, and as my mum always used to say, you never lose money being too early and selling too early. You'll always lose money if you buy late and sell late. So I'd built up around about 30 to 35% bear exposure between the UK and US. And I was also attuned to the gold market, and we had about 35% gold mine exposure at that moment in time as well. Too early, hence we took a setback. That coincided with an annual compliance visit. That other sort of font of wisdom and box-ticking mentality who descended on me in July 2000. We went through the normal sort of rigmarole that happens in compliance visits, and which included, well, how's performance going? To which I had to say, well, not that well actually, the last couple of years, and we're probably down 25-30%, which made him look very concerned and said, well, perhaps you tell me what it is that you're invested into. So when I said to him how much bear weighting and how much gold mines, it wasn't so much the bear weighting that concerned him, it was the gold mine exposure. He nearly fell off his chair and said there about, well, that's hyper high risk. To which I couldn't help but say, well, how do you define that? How do you define high risk as opposed to hyper high risk? To which he responded by saying, well, textbook investment says you should have no more than 5% of a portfolio into gold mines because of the volatility. My natural response was to say, that's textbook. This is the real world we're talking about. And in all fairness, if you've got 5% exposure to anything, it's not really going to make a lot of difference to the bottom line whether it goes up or down. But of course, with that weighting, if you are too early, then it does have a reasonable detrimental effect. So anyway, he just couldn't sort of let this go. It was like a dog with a bone for the rest of the meeting. And when he left, he said, oh, well, I'll certainly be including in my write-up, follow-up about this. I said, I'm sure you will do. And these two charts here are from a response that I made called a topic sheet, 4 pages if anybody wants it, which was dated in July. So his visit was probably May time, come to think about it. And it was called risk and diversification. And I touched on all sorts of areas of risk, whether it's political risk, inflation risk, currency risk, market risk. It just goes on and on and on. And actually, if you worried about everything there, you wouldn't get out of bed in the morning because life's full of risks. But the two important charts from it were the top one there, which is the S&P 500 over 30 years from 1970 to 2000, and the lower one being the physical price monthly data of the gold price over the same period of time, overlaid by the red line, which is a measure of standard deviation or volatility. And at its simplest, when the red line is low, and effectively you've got low risk position as far as the underlying market that you're measuring against. And when standard deviation increases, then that's starting to tell you that things are getting a bit risky. So it was part of the fact that it was on deaf ears as far as the regulator was concerned. They didn't even have the decency to reply to the topic sheet. It was a useful couple of charts there to use on clients who, needless to say, were increasingly coming in to see me after a couple of years of underperformance to say there about, well, what are you doing wrong, Charlie? You know, what is it that you're missing? To which I'd show them these charts and say, well, look, what I want you to tell me now is extrapolate forward 10 years, where should I be investing your money? Should it be in the S&P 500 or should it be into the gold market? And you won't be surprised, or you may be surprised to know that 99% of them all said Wall Street as opposed to gold, and that of course is because of the sentiment and the DNA of majority of people, and that whether they're professional or private investors, and that is the tendency to extrapolate forward what the immediate past has provided. But of course we know, with the hindsight of history, that the gold price went from $250 up to 1920 or something by 2011, and 10 years later the S&P was still at 1500-ish. I thought I'd introduce this slide because it was actually in 2002 where the Contrarian came in touch purely by chance with Mr. Prechter, the whole context of Elliott waves, and subsequently the beginnings of social and cultural input, which then morphed into the Socionomics Institute. And I've got to say it was a life-changing experience for me, and both professionally and personally. But of course, you know, integrated within the use of both is the works of Fibonacci. So I couldn't resist including a slide there. Sometime in the 90s, we'd been on a vacation to Tuscany, lovely part of Italy, which included the obligatory visit to Pisa and to look at the Leaning Tower on the left there, which in itself is a wonder to behold. And of course, I'd never heard of him at the time, but you only have to go about 50 metres up the road and you'd have looked at a statue on the right-hand side to Leonardo Fibonacci. And both of the same sort of circa, 1170 was when Fibonacci was born, and when the initial stages of building the tower, although the tower took about 150 years to complete. But I, like most visitors there, they all look at the tower, they eat the pie, but nobody goes to look at the statue of Leonardo. I've included that, and forgive me for cribbing one of Elliott Wave's slides, but if I'm talking to an audience of, or one-to-one potential clients on the subject of what works or what doesn't work in markets, I think that one slide just about sums it all up, which, just to remind, is on the left-hand side are top 20 New York bestseller business books between 1976 and 1984, bearing in mind that the global markets, particularly led by the US market, had been in a secular bear market from 1966 through to 1982, and the Dow Jones index, probably the most watched stock index in the world, had hit 1,000 in it hit 1,000 in 62 if I remember, but early 1960s, and stayed at that for 16 years through to 1982, albeit that there was a fairly large drop in the middle of the 70s. Then we shouldn't be too surprised that most of the best-selling books on the left-hand side of the screen at the tail end of the bear market were all talking about gloom and doom, the crash of 79, the great money panic, make money in a depression, etc., etc., except for one standout, being the blue cover tape measure Elliott Wave principle published by Proctor and Frost, which was effectively suggesting there that we were on the cusp of the biggest bull market in history. And no doubt at the time he will have been ridiculed and poo-pooed and said you must be crazy, but time has borne that out as far as saying it was right on the money, albeit a year or two too early. Whereas with the right-hand side, we're looking at 1998 to 2008, and following this bull market of in history, greatest one in history, surprise, surprise, the tone of the bestsellers are Dow 40,000, Dow 30,000, Dow. I think we've even had a Dow 100,000. Make your money in real estate. Effectively, don't even look at stocks. Go off and play golf all day. They look after themselves, and everything's going up, except in the one standout, which was how I first come across Elliott Wave International, which was through Conquer the Crash. And of all the reading that I'd done over the prior 20 odd years, this book stood out to me as being the most logical, most common sense approach to how markets actually work. And by that time I'd tucked a few years of technical analysis experience under my belt, not including Elliott Waves. It was like drawn back the curtain. So this became the change, and on a shared experience with Elliott Wave publications, and including the increasing amount on social events, then you start to think that way. You start to think socionomically. You look for things that are supportive of the case, and that was one good example on the build up to the real estate bubble or fall down. And this was as far as the US was concerned, and as we can see, by 2004, 2005, there was something like 15% of the workforce in California, biggest state in America, were employed in real estate. You can see there from the chart that in 2004, 2005, when annualized returns had peaked for average residential property prices, then a good 40% of sales weren't for demand for housing to live in, it was for speculation. They were either for second properties or they were buy to let as investment purposes. So again, a little bit like the examples with Hong Kong and Japan, it was all grist to the mill. It was an alarm bell and a warning amber sign to say we're getting ever closer to this all fall down. And I was using this and similar things like Hong Kong and Japan as example, talking to people in the UK at this same time, and making the observation that they are interlinked with the stock markets. And by then I could talk a bit more about, and it's to do with super optimism building up the collective social mood. And but of course this continued objection from the public was, well, we live on an island, they don't build land anymore, there's a finite amount there, and it's development restrictions, etc., etc. So therefore that's going to hold our market up. To which I couldn't help but turn around and say, well, you know what, last time I looked at Japan it was an island, and come to that, Hong Kong was an island, but it didn't stop 90% drop in the former and 75% drop in the latter. So what makes you think it's going to be anything different here? But still they say we're a different type of island. That view has been aided and abetted by the media, politicians, you name it. Everybody's been on one side of the camp, which is to say they're about finite amount of land, growing population, and even to this day as I talk now, they're still banging the drum and saying we've got to up our game and build 250,000 new houses per year, each and every year for the next 3 to 4 years to meet the demand. Whereas if you look under the bonnet, excuse the small print that's there, it actually says through the main, if you like, the wave 3 part of it, from 1997 through to 2007, the population grew by 5% in the UK, which is a heck of an expansion in a decade. And of course, a lot of that would have been on immigration, laxer immigration policies, particularly from Europe as opposed to outside of Europe. But over that period of time, the housing stock actually expanded by 10%. So that kind of negates the argument to say there's not enough housing being built. But of course, the real kicker for why it happened is the final figure there, which says mortgage lending or credit expansion went up by nearly fourfold, 390%. And that, of course, is what drove the prices up. But we'll come back to that in a minute. Another gem that came out from you guys, if I remember from Bob, in 2006, which was the first time I think I'd seen nominal versus real presented, albeit that it was presented as far as the US was concerned. And it was really quite an eye-opener there. That sort of got my grey matter going, and it made me question whether it would work, but outside of the US. So what that table there is, I started on my Bloomberg to look at just about any index or sector index or currency relationship globally, and look at it in nominal and real terms. And as long as you currency adjust so that it's comparing apples with apples as opposed to apples with oranges, then it does tend to work. And although the crash had started, the financial crisis had started in 2007, this slide wasn't put together until, well, as the date says there, 7th of August 2008. What I did was put the then nominal figures for the various indices here on the left side. So whereas the Dow Jones had peaked at 14,700 off the top of my head, it had already dropped by 3,000 points down to best part of 11.5. I then put what the real figure was alongside. The gap was the difference between the two in percentage terms, and what the nominal fall had been calendar year August year to date 2008. So that was the expectations based on nominal versus real on the underlying gap figure. In the event, if we update it to March 2009, that was the outcome for each of them. So although, you know, they weren't exact as far as the figure, the important thing is the trend was certainly correct, and that they were all likely to fall, and they were likely to fall by decent amounts. How we were at the time, and I was talking to, measuring to clients on what I considered to be the world change from an investment standpoint in really January 2000, because that's when the markets peaked in real terms as opposed to nominal. Although we got there by a fairly tortuous route, that was the scoreboard as of March 2009. So it had really been a game of, it was 2-1 to us. And not by design, but I was effectively running an inverse index tracker. So the blue line was the world index in sterling terms, were the green line, which is the different mandates that I was managing, and the red line was sterling, 90-day sterling deposit with interest reinvested. And for most of that period, indeed, cash has indeed been king. Why bother with the markets? You'd have done just as well with on deposit. And it was a hat tip to Matt's recent comment on statistics looking back on performance, where I couldn't help but say there about, would you have travelled back in time and invested? There were certainly times during the 2003 through to 2007 you wouldn't have touched me with a barge pole. You'd have thought I was balmy. But we were quite pleased there. I wasn't too pleased with the Voyager Pathfinder return there. As you can see, it's run by the same, managed by the same guy, same asset allocation as the one pathfinder at the top there, there's quite a difference between 80% and 34%, and I can tell you exactly why it was. The only thing different between the two was that within Voyager, I'd invested in, and it was the only UK regulated investment that I held, which was regulated by the Financial Services Authority there. And surprise, surprise, in 2008, that entity went bust. But that's life. Corny that it is, the greatest love story of all time, love story with Ally McGraw and Ryan O'Neill. Well, in fact, it's not. Sorry, you two, we've got to shift you over, because the biggest global love affair, which is literally global, has got to be with real estate, and in particular residential real estate, whether we're looking from China to California, going from east to west, so that encompasses just about everybody. That's a chart courtesy of Savills, which are an international, well-established UK-based, to be fair, upmarket estate property company, and like I say, they're global in nature. But this was a slide taken for one of their papers of last year, where they neatly put in there the chart up the top there compares, say for example, the brown one, there's the chart there, so it's America. So effectively 21% of global real estate wealth propped up by population that represents 6%, just over, which I thought was quite useful to look at, but equally so with the three numbers on the bottom there. Total amount of gold ever mined is $6 trillion. The value of global stock markets is actually more like about $58 trillion as we sit today. And on the right hand side, just to put it in context, global value of real estate is $217 trillion, of which the best part of it's in fact 162 trillion is residential, much of it propped up by debt. And again, that's a warning sign to a contrarian, and it's a warning sign to a socionomist. And we started in the east and we'll return to the east. So that's average house prices back in Hong Kong, and the blue bar chart at the backdrop is Hong Kong credit, and as you can see, that's alive and well and going hand in glove, as the two do. Hong Kong is now the most expensive real estate, residential real estate market in the world, at somewhere in the order of 18 times price to average earnings or wages. Top end in London now is it had peaked at about 12 times, and even nationally for UK it's at about 6.5, 6.75 times. And you know, it's not that long ago where an extreme was if we got up to 3 times, 3.5 times, and it's all different degrees the world over. But China, which I've mentioned on there, we've got well, again, I've used Hong Kong as an example. That shows the Hang Seng Index in the black line, the Hang Seng in real terms, in other words, if we strip out the debt, is the blue line. Interesting to see that they both peak at the same two dots here, but years apart, as they do dots on the bottom here, years apart. So that's suggesting that there's a fair readjustment to come from the Hang Seng Index. And the red line that's on there is average house prices. And as we can see here, as opposed to back in '97 where I started the presentation, whereas it was a slight lag with property to the to stocks, now it's property that's actually leading the index. So I'd like to take this opportunity of thanking the Institute once again for the opportunity of talking, of thanking you very much for the ongoing input and the pearls of wisdom that continues to pour out from the Institute on all sorts of areas, you know, not just the markets, but you know, whether you want to talk about politics, whether it's Brexit, whether it's the surprise of the Donald winning the election in the States, whether it's what's going on in the Middle East, the increase in global fisticuffs, hat off to the Socionomic Institute in their way of at least forewarning people about this, predicting. And my word, there's been an awful lot of accurate prediction. But of course, as Bob rightly said in that slide there, as a profession is another matter. People will look at you as if you've just been beamed down from Mars. You are so out of tune with what the majority are out there. And of course, even when things come around to what you'd been predicting, they will not put it down to you. That will be their own wisdom of understanding it, and they start to extrapolate that forward just at the time that things are starting to change again the other way. I've set up a website called Simply Socionomics with the objective of sharing the knowledge that's created from the Institute, but hopefully trying to bring it down to bare bones and to simplify it, to make it easier for a wider audience to perhaps read, because you do have to work at it. As I said from the beginning there, I do believe that contrarians, it's in their DNA, they're either born contrarians or they're not, whereas this subject matter, you need to work at it. It's initially, it's counterintuitive, you have to think it through somewhat, but then gradually it's well worth the time and the effort, because you start to think socionomically. And there's not a current affairs bullet point on a daily basis that doesn't come out from the main media, whether it's on the radio, the TV or print, where you immediately look at it with a socionomic hat on and interpret it with a different view to what certainly the provider of the traditional news is trying to do. So do come visit us at Simply Socionomics if you can find some time. Thank you very much.